Hey everyone, thanks for stopping by. This is Phil with Foundation Wealth Planning, and today I want to talk about the emergency fund. So, what is the emergency fund? How much should we have in it? Uh, this seems like kind of a basic concept, but it is a foundational building block to your financial health and well being. And so, I haven't done a video about it. I need to have it out there so that people can see what that's all about. Now, there is a few things that I'm going to go over in this video, and if you like it, please, give it a thumbs up, like, follow the channel, follow my website. Come back over here on Instagram and everything, wherever you found the video. Please continue to follow and check out more. So, I hope to do more of these videos moving forward. Just a few minutes for a quick hit of financial knowledge. So, an emergency fund is there to be kind of that buffer between you and being up a creek without a paddle, as they might say. So when you think about an emergency fund, the typical advice is 3 to 6 months of expenses. So, what does that mean? And does that apply to you? So there is some variation on that. And really that's a guideline, right? So people usually say in terms of months of expenses, because that gives you a way to think about how long you could live and pay your bills if you lost your job. In this economy, most of you, if you were to lose your job, you could find one still pretty fast. But if we do hit a recession where we are going to be, people have higher unemployment time periods, you may actually be dipping into that. So if you take your monthly expenses, and I would take, not the bare bones minimum of what you would need to live, right? Because we always spend more, or more expenses come up than maybe what we envision in this picture perfect life. So give yourself some buffer, take that and multiply that by, 3 or 6 months. And that's really a good way to do it. You could take also, your money and just say, how much do I need, if I were to have some sort of catastrophe, right? You can look at various things like, what's my deductible on my medical emergency? What is my out-of-pocket maximum, right? So if we lose a job, that's one thing. If we have a medical emergency, that's another thing. What's our elimination period on our house, right? Do we have deductibles on if we have a new roof, new HVAC, right? How much of that has to come out of pocket versus what do you have insurance for? What does that cover? So there are various things that can happen when you own a house. Emergencies come up, you got to pay for it. When you are owning a car, right? You have deductibles and things like that come up with the car. If there's a wreck or what have you, insurance company might come to help you. It might take some time before they do that. Maybe they don't make you all the way whole. There's a lot of reasons why you want to have an emergency fund. And the 3 to 6 months is just simply a guideline. And you can think about it in terms of, well, okay, I could live for 3 months on basic expenses if I lost a job, or that pool of money can be used for some of those other things that might come up that are unexpected, right? Expected, but unexpected, right? We know that things are going to happen where we got to go to the hospital. We just don't know when or how much that's going to cost. We know that something's going to happen with the house. We know that something's going to happen with the car at some point. So these are, unknown in terms of scope or when they will happen. But we shouldn't be surprised when things like that do happen, because that's life, right? So we got to be prepared. And we don't want to have to go into debt for this. I mean, this is how you get into credit card debt. That's how people get into personal loans, taking out loans against their house. And you might be one of those that's in that situation, and you need to work on digging yourself out, which that would be another video talking about some of that type of thing. But in terms of trying to either avoid going into further debt or getting yourself from getting into any more debt or any debt at all, would be making sure you've got an emergency buffer. And typically you would look at 3 to 6 months if you're married and both husband and wife are working. You would maybe be more comfortable on the 3 month side potentially. If you're a single income, you would definitely want to be higher to that 6 month side. And if you're getting close to retirement, or if you're going to start a business, or if you're going to do something else, having more like 12 months in place can be really beneficial in those situations. And the other question that people get is, okay, so I've got this 3 or 6 months expenses. What do I do with it? Well, you've got obviously a little bit of money in your checking account. There are money markets account at the bank, and high yield savings accounts. They are very similar. How they function on the back end is slightly different, but a money market, if it's FDIC insured, or a high yield savings account, are gonna, from your perspective, gonna look very similar. And so you can pick one of those at your local bank, or you can pick one that has a little bit higher yield on it. If you've got excessive amounts in there, you could go something that's a little bit more of interest rates, but it's going to be a little bit less liquid. So liquidity would be how quickly can you turn an asset into cash and be able to spend it, right? So everything that's in your emergency fund needs to be liquid, needs to be able to quickly be moved from whatever it's in into being able to be spent if need be. But the amount of liquidity that you would need can vary based on, the liquidity scale can be a little bit different. So you got a checking account, but then you've got things that on the other side that are more like, short-term CDs, treasuries. Trying to think if there's anything else. Those would be probably the two that come up the most. You could put a little bit more in there, but they're going to be locked up a little bit more. So a treasury, you could liquidate, but it might take a little bit more to get to. A CD, you might do a 3, a 6, or even a 12-month potentially CD. But again, if you're waiting for that to expire or to come due, would be the term you would use. You don't want to have all of your savings in those types of investment vehicles. So, this is certainly not advice. You would want to talk to an advisor to talk specifically about your situation, but those things can be out there. They might play a role in your situation, but this is for education purposes. Talk to your advisor. If you have questions on that about your situation, feel free to reach out to me. And I hope this was helpful. Hope this got you a little bit more background on the emergency fund, the importance of the emergency fund, and how to get to it. But basically, keep it in something that's easy to get to: savings account, high yield savings, money market. If you've got a lot more in there, you could potentially put a little bit more into something a little bit more like a CD, but you don't have to. Keep it easy to access, get a little bit of interest on it, and make sure it's there when you need it. Thanks for stopping by. God bless and have a great day.